just take a few minutes to talk about consumer loans in Chapter 7 with you. So, this chapter describes different consumer loans. You'll be able to differentiate between different consumer loan types, identify the sources of consumer loans, choose the best loans by comparing finance charges, maturity, collateral, and other terms, and describe the features of and calculate finance charges for single payment loans in this chapter. There also is some opportunity sort of cost analysis of thinking about loans and if it would be better to pay cash or take out a loan. So I'm going to talk about some aspects of the chapter here. I'm going to create a different video for sort of the last couple of bullet points in these slides. So this video will be a little shorter, but basic loan information. So consumer loan basics. Consumer loans are not revolving, meaning that you basically take out a loan for a given amount of money and you pay it off, versus a revolving sort of loan like a credit card where you have this outstanding open line of credit and you can make purchases against it and pay it off and sort of have this outstanding revolving balance. These would be non-revolving loans. Generally, consumer loans are used for larger purposes. The loan would be wholly paid off versus smaller purchases that would be made with a revolving loan or an open line of credit. Using consumer loans. They're normally loans made for specific purposes. They will have a formally negotiated contract that specifies the borrowing terms and repayment for a one-shot type of transaction. So unlike a credit card, no more credit is available. The amount of the loan is fixed. They don't involve credit cards or checks, and generally people are using consumer loans to borrow for big ticket items. So some facts are fantasies. Is it true that buying a new car is the only reason that people borrow money through consumer loans? Are consumer loans set up with fixed rates of interest or variable rates of interest? They can be both. And people are using consumer loans to buy things other than cars. A savings and loan is the only type of financial institution that is prohibited from making consumer loans. They're actually able to make them. Single payment loans are often secured with some type of collateral and are usually relatively short term in duration, so maturity of 1 year or less. That's not true. They are normally secured with a type of collateral, but they're not necessarily short term. You can use the discount method or the add-on method to calculate interest. But the discount method isn't a method of lowering the effective interest. It's just a way of thinking about what the interest is on that loan. Okay, so if you can take out a consumer loan, it doesn't mean you need to. Purchases, really, I think the advice should only be made when you have budgeted for the purchase. Generally, purchases using consumer loans should have a useful life longer than the term of the loan. So if you were going to buy a car and you have a 6-year loan on it, how long does that car last? Does it last 10 or 15 years? Generally, when you're thinking about cars, you can kind of see, well, how many thousands of miles will this car reasonably expect to achieve? And hopefully your loan term will be less than the useful life of that vehicle. Different types or uses of consumer loans are essentially auto loans, which are collateralized, other durable goods loans, such as furniture, which are less collateralized. If you take out a loan to buy a piece of furniture, the depreciation rate on that furniture is so high that the collateralization benefit is really not there in the same sense that it's there for auto loans. Education loans are not physically collateralized, but they are collateralized by the fact that you go and you obtain an education, which hopefully is tied to a future stream of income. So there is some implicit collateralization for education loans that I would say is stronger than for durable goods loans. You could take out a loan to go on vacation. That would be a personal loan. And then consolidation loans are a type of loan that is going to consolidate your revolving debt like credit card. So we're going to take revolving debt and turn it into non-revolving debt, and that can occur with a consolidation loan. A consolidation loan, and I receive um, like mail saying, hey, do you want to like consolidate your student loan debt if you have student loan debt, or do you want to consolidate your credit card debt? And they're basically going to be companies that are going to take on that debt for you, consolidate it, apply a certain term to it, and they're going to turn it into an installment loan for a certain rate of interest. They can be rather costly, but they could be helpful to people who are just having a hard time really thinking about how to pay down their debt. Okay, so a type of consumer loan is a student loan, and student loans are a large part of the outstanding non-revolving and even non-revolving and revolving consumer debt in this country. There are different types of federally sponsored student loans. They're obviously going to be cheaper than student loans that are commercial in nature, meaning they're issued by a financial institution such as a bank. So Stafford, Perkins, parent loans, Stafford loans, and Perkins loans, they are loans that are taken out by the student themselves, whereas a parent loan is going to be a loan that is taken out by the parent for their student's education. Generally, loans can be either subsidized or unsubsidized. A subsidized loan means the government pays the accruing interest while you're in school. This is very powerful. 5 to 7% interest on $20,000, $50,000 of debt that some students are taking out on an annual basis to fund private education, for example. When it's accruing while you're in school for 4 years, the value, the notional value of that loan is increasing, and the notional value of the loan increases the debt burden on you when you graduate. So sometimes it's good if you have an unsubsidized, part of your Stafford loans might be unsubsidized and part is subsidized, versus your Perkins part is subsidized and part is unsubsidized. It might be good to be paying at least the interest on the unsubsidized portion while you're in school if you can afford to. Okay, student loans. So this table kind of gives a brief overview of the different loan programs. So direct loans would be Stafford and Perkins versus PLUS loans, which are the parent loans, the PLUS loans. And I looked up the recent interest rates on these. Interest rates for student undergrad subsidized loans are as low as 4.99%, whereas the interest rate on a parent PLUS loan is as high as 7.54%. So right now, there's a range in those interest rates. Graduate school and professional schooling loan rates are substantially higher, and there are limits. So there's going to be cumulative borrowing limits, and you need to be aware of this when you're attending school. Like, how much do I need to budget in terms of the loans that I need to take out for this particular program, for this particular job? You can have a certain amount of outstanding debt and loans that you take out, and then over that, you're going to have to reach into the commercial loan market. Parent loans don't have a dollar limit. They're really just going to lend up to the cost of attendance minus any financial aid received. And cost of attendance can even include like your housing and your food expenses. That's part of the student's budget. But do you have a parent who's willing to take out these loans for you? So that's something to think about. There are loan origination fees with even federal student loans, which are funded through the issuance of treasury debt. So the federal government issues treasuries. They issue them to pension plans, foreign investors, foreign companies, foreign governments, and the money that we receive off those U.S. treasuries, we turn around and we lend it out to students. And then the government actually charges loan origination fees, much like your mortgage origination fees. Generally, loan terms for federal student loans, they start at 10 years, but this can always be extended. So I wanted to take a look at some resources that are provided. So if you go to federal student aid, you can get a better understanding of what current federal interest rates are on loans by type and disbursement date. So these are current loan rates based on disbursement date. If they were disbursed, which means given out earlier, the loan rates are going to be different. Okay, and they talk a little bit about like how interest capitalized, how to pay down your balance. And then here's these loan origination fees. So loan fees are added on to the amount that you borrowed, sort of in a one-shot thing. So they're not accruing, but it's like 4% or 1% of the value of the loan. Here's some previous year's interest rates. And you can see they sort of vary. They're going to be based off of base rates in the economy, like our federal funds rate. So now that the federal funds rate is increased, they may be increasing. They're actually down versus lower federal funds rate back in 2013, which I think is an effort by the federal government to increase educational feasibility, or to reduce expenses for those taking out loans to go to school. So there's a lot of interest or a lot of information here about student loans, and it is all up to date, unlike my PowerPoint slides, which will become outdated in the next semester. There's even so you can see here, temporary 0% interest rate extended. So this is something to kind of be aware of with student loans. It was something that I honestly had to become aware of when I took out my own student loans. So your student loans can be consolidated like credit card debt. If you have them, you will most likely be contacted if you have multiple different types of student loans to see, if they can consolidate them, lower the interest rate. They're obviously going to do that for a fee. Something that both the federal government and the organizations that are managing the debt on behalf of the federal government will do is they'll allow you to pause. And sometimes if you go back to school, they'll actually pause your loans, and so you really have to be vigilant about making sure that you're still making payments. They do allow you to extend them and pause them for different reasons, and I've seen student loans that have up to 20-year maturity time frames associated with them. And while that's really useful if you do need to put your loans on hold or to reduce the payments, just note that the interest is accruing at the same rate. Okay. Some things to think about with student loans. They cannot be included in a bankruptcy, so you can't write them off in bankruptcy, which is a little bit challenging. Just to put it in perspective, for every $10,000 of debt, you'll be paying at least $111 per month for 10 years. That's the lowest interest rate that's available for those federal subsidized direct loans. So like for a $40,000 loan balance, you'll be paying $444 per month for 10 years. And actually, I think I calculated those off of the average between the high and the low. So between the direct, subsidized, and maybe it was even the indirect or the parent plus unsubsidized. Remember that unsubsidized debt accrues interest while you're in school. Loan limits cause borrowers to need to borrow at a higher rate of interest. So if you're meeting, if you're getting to those limits, then, you're going to fall into the next category. So if you exhaust the unsubsidized category of loans up to a certain amount, then you're going to have to take out then you're going to have to take out the unsubsidized loans, and those will have a higher interest. Also, commercial lenders charge a higher rate of interest. So when you exhaust federal loans, amounts, then you'll be reaching out to commercial lenders who will offer you loans, but at a higher rate of interest. Okay, so consumer loans have some characteristics. They're really similar to a mortgage in a lot of ways. I mean, you can have a single payment, which means for a specified period of time, at the end of which you're just paying principal plus interest, like a giant balloon payment. But I see that a lot of consumer loans tend to be installment, which are paid in a series of fixed scheduled payments. Payments are both part interest and principal, so they're amortizing down to zero. If they're fixed, the interest rate and payments will remain the same over the life of loan, versus a variable interest rate, which is a little more risky to the consumer. It benefits the lenders, and those interest rates will fluctuate with changes in the interest rate environment. So if the federal funds rate, which is our base rate in the United States economy, if that changes, if it increases, the variable rate on your installment loan will also increase. Okay, where can you get a loan? Obviously, we talked about the federal government issuing educational loans. That's one place, but you can also get them from commercial banks, from consumer finance companies, from credit unions, from savings and loan institutions, from sales finance companies, life insurance companies, and your friends and relatives. Not advisable. Depends on your situation, really. But I would say that about 75% of all loans are coming from credit unions, finance companies, and commercial banks. A lot of car or auto loans are made by actually the financing arm of that automobile company. So, like Volkswagen Credit or Toyota Credit, these are really large companies in themselves, right? So they're producing the vehicles and then they're selling the vehicles through the financing of them in their financing corporation. So it's a really fascinating business model and increases affordability for vehicles. Okay, features. There's definitely going to be finance charges. The loan will have a maturity, which means like how long until I have this loan paid off. The finance charges are the interest rate pretty much that you're being charged. The total cost of transaction would include things like your loan origination fee. Collateral is any specific collateral that's tied to the loan. In a home purchase, it would be the home as a collateral. In a car purchase and auto loan, it would be the auto. And there are some other important things to think about with a commercial loan, like are there prepayment penalties? What are the late fees associated with missing a payment and being late on a payment? Are there any payment due dates that are sort of set in stone? And again, we're kind of back to this debt safety ratio concept. So if we're taking out a consumer loan for something, it's important to keep track of all of the debt we have and think about our monthly payments, right? So we discussed in the previous chapter that debt safety ratios should be less than 20% of our monthly take-home pay. So our income after taxes in the denominator and our total monthly payments in the numerator. So we'll take all of the different debt items that we have, put them in the numerator, divide by our monthly take-home pay, and that number should be less than 20%. Let's see what else. Okay. All right. So single payment loans. These would be any loan for which there is a single payment that's being made on collateral. And essentially, in legal terms, there is what's called a lien that's created when the single payment loan is created. And that lien is the legal claim to liquidate collateral to satisfy the loan in the event of a default. Chattel mortgages are used when there's actually movable property and collateral needs to be put in place to secure the loan. A collateral note is defined as a lender can sell collateral property in the event of the default. So they'll hold on to the collateral note, and that gives the lender the ability to sell the collateral property that they have access to in the event of a default. Any single payment loans will have collateral associated with them. They will have a loan maturity, which means how long will the borrower be paying this loan off, and they will have a loan repayment schedule. Again, the concept of are there any prepayment penalties included in the terms of the loan, and oftentimes a loan can be sold. So if you are a borrower and you take out a loan and the lender sells it, this often happens with mortgages. So mortgages are packaged up in little bundles and they're sold. And this actually reduces the risk of holding them, right? So if we were to, for example, like take all of the houses in Humboldt County and take those mortgages, and Coast Central and Redwood, I think it's like Coast Central, Redwood, Capital Bank, Umpqua, all of our local banks were to take those loans, sell them to somebody, and then the person that they sell them to sells them to investors. Then that really spreads the risk because those loans hold consolidated positions in Humboldt County real estate, which is a great thing, right? But I don't know, we could have a natural disaster, or we could have some sort of issue that impacts employment in the area. And then those banks would be subject to a lot of risk, geographic risk. So loans are rolled over. A lot of time your mortgage will be sold to a different company, and banks do that to manage their lending risk. My mortgage I've had for 5 years, it's still with Umpqua, but that could change. Okay, so I'll discuss some more details on finance charges and how to calculate all of these different little interesting calculations about consumer loans in a different video. Thanks for tuning in.